Hi, I'm David Ware, and welcome to our Quarter One Economic Update. I have some really great information to share with you on the following screens. So let's dive in. First, an educated client is our best client. So it's our job to provide you with knowledge, with information to help you make a good financial decision. We're here to help you, guide you, and provide that education that's necessary. We see that as a very important partnership between the client and the advisor. So let's take a look at the equity markets for 2025 for the first quarter. Not off to a great start. Hit highs in February. Since then, we've seen the markets trade down. Not unusual. We had a really good year, 2023 and 2024. So not unusual to see that pullback and that correction. Also, we've got a new administration. There's some uncertainty, as you'll see in the following slides regarding tariffs. That's a big driver of this volatility right now. But as we see, the market, the stock market, is down. So we're going to look at some other economic factors to consider. Inflation has been on everybody's mind, for the past several years. As you can see, 2022, right at 9%, but we have seen that, come down. Most recent reading for core inflation is 2.8%, down slightly, from the end of 2024. But again, that's good news, to see that inflation number come down. It's still above the Fed's target of 2%, but it's, come down to a more, manageable level. Yes, we'd like to see that come down and continue to come down. So we'll have to keep monitoring that as the 2025 as it unfolds. Interest rates. Interest rates has been a lot better for savers, for people looking for fixed interest rates. It's been good, but for borrowers, your mortgage rates, your auto loans, it's been more expensive to borrow money. The Federal Reserve, economists thought they were going to lower rates 7 times in 2024. However, they only lowered them 3 times. And the first 2 meetings of this year, January and March, no change. There's still some anticipation that they will lower rates this year. But we have 6 more meetings. It's something that we have to monitor. I think that most economists do think they're going to lower interest rates a little bit, but that's something we'll have to watch on the next meeting in May, whether they hold steady, or decide to continue to lower rates. Here you can see it's settled around 4.25 to 4.5%. And it's not the highest, but it certainly has not been the lowest, especially from 2010 to 2021 when they started raising the rates. So the bond market, just as important as the equity market. Interest rates and bond prices, they have an inverse relationship. So interest rates go up, bond prices go down. I think we all witnessed that in 2022 as one of the worst years for the bond market in recent memory. As you can see from 24 to 25, as we look at the 10-year Treasury bond, which is a benchmark that you can look at. It's tied to mortgage rates, auto loans, things like that. It did increase quite a bit, 3.95 to 4.57. That's a pretty big increase. We can see that it did tick down slightly, down to 4.23 in March. Really would like to see that rate come down. So as the equity markets continue to experience volatility, we would like to see money, go into those safe haven Treasury bonds, and that would push the yield down and bond prices back up. That would be a good indication. So that's something to monitor and keep watching, especially if we keep experiencing volatility in the stock market. So we alluded to this earlier, new administration. That means, new policies, changes to regulation, and that is right now causing some uncertainty. And the stock market does not like uncertainty, but this isn't unusual. We change administrations every 4 to 8 years, so it's not unusual for the market after a new administration comes in for there to be some volatility while the market tries to figure out the direction of certain policies, like regulation, tax policy. As you can see on the following slides, we'll get into what's on everybody's mind are tariffs. What is a tariff and what does it mean for the economy? So a tariff is just a tax that a company pays another country to be able to bring their product in. All other countries have some kind of trade barrier against us, whether it's tariff or it's through a regulation. We're not able to sell our products as easily as other countries can sell their products to us. So tariffs are being used, what it seems like, as a negotiation tool to maybe realign some of those trade agreements. But it can be a barrier. As we see for American goods overseas, it is a barrier when we're able to import, much more goods from places like China, Europe. So what it sparked, the tariffs, what some are calling a trade war, what the news is portraying each and every day when you turn the television on, because some of the companies or countries, specifically China, have retaliated by raising tariffs themselves. It seems like the other trading partners like the European Union and other Asian countries, are negotiating, trying to, work the trade agreements out. And that's one reason the Trump administration has most likely paused the tariffs that were initially enacted in the other countries while they try to come to an agreement. And so hopefully they will, but it looks like China, they've been raising tariffs tit-pat. Might be a little bit more difficult, agreement to come to, and that's something that just have to monitor and see, what ultimately, comes out of that. With all that said, it's all out of our hands, and it's not something that you or I can control. So I think it's important to focus on things you can control, such as your behavior and your reaction, and not being over emotional. We've already done this by understanding your time frame, your risk tolerance, building diversified portfolios, and understanding whether you're taking a distribution or if you're still accumulating wealth and you still have several years before you need that money or anticipate needing that money. So those are things that you can control. If you feel like your risk tolerance has changed, or if your time horizon when you need the funds has changed, that would be a good opportunity for a review to look at how your investments are structured and if any changes need to be made. So volatility, the risk of volatility doesn't hurt you. Equities are a long-term investment. As you can see on the chart, the equity, they don't go up in a straight line. We've had a lot of pullbacks, downturns, corrections, through the years, but you can see with the green line over 40 years, the purple line over 30, the blue over 20, long-term investors have been rewarded by being committed and disciplined and staying focused on the long term. Equities aren't a short-term investment, so if it's money that you need now in the next year or so, you don't want to have that in the equity market. Those need to be, it needs to be protected in somewhere safe where you can get to it quickly. If you're able to invest for a longer period of time, equities have rewarded long-term investors. So that kind of wraps up some key economic factors to consider with your investments. Some key takeaways. We are in correction territory with the S&P 500 for the first quarter of 2025. Tariffs are having a significant impact on the equity markets because of the uncertainty on what the trading landscape is ultimately going to look like. The federal funds rate is right at 4.5%, with the Fed forecasting 2 more rate decreases this year. U.S. inflation has decreased from 2.8 from 3%. Good news. Hopefully we'll see that continue to come down. Bonds typically are less volatile alternative to equities and are a good part of anybody's portfolio, or should be, because they can act like a cushion when there is volatility, uncertainty, and the economy is not as robust as it needs to be. Focus on what you can control, such as understanding your time frame and your risk tolerance and making sure you have a diversified portfolio. Market declines, they're part of the investment experience, are going to happen. So pullbacks, corrections, all that is necessary, and it's a part of it. It's expected. So maintain a well-devised long-term plan. If you have questions, We do review things on a very consistent basis, but if it's been a while, like I say, if circumstances have changed, such as your time frame, when you need the money, or your risk appetite has changed, these are all good opportunities to reach out so we can look at things in more detail and focus on your personal situation. So we're always here to help. So please reach out, call us anytime. We're happy to talk about any of the concerns that you may have. I want to thank everybody for watching the economic review, and we're here, and we'll talk again soon. Bye.